Ideas on how investors can actually play a potential, I'm going to say it, Eric's favorite term, Grexit, Greek exit.
Well, you know, it's interesting. I mean, there's a fundamental structure to trades that are successful for hedge funds. And what we find in general, you know, is that they have three sort of characteristics. They're consistent with fundamentals. They have a varying opinion. You don't want to be with the crowd, and you want to have an asymmetric return. When we look at the setup of some of the situations that you've got out there right now, a lot of them, you know, the forward curve in the futures market, looking for a June, July rate hike, a lot of that is in the market right now if you look at the Fed curves. If we look at something like Italy, though, and the Italian bond spreads, Italy is actually continuing to tighten. Italian triple-B banks are tightening versus Deutsche Bank as we speak. The notion that their credit spreads have gotten better, you're seeing an element of market complacency. Also, interestingly, even at the retail level, Italian deposits at banks, by man-in-the-street deposits at banks, are up on the order of 18% since their peak. The Greeks have had the good sense to take about a third of their money out of the banking system, which is extraordinary. So you've seen the...
But hold on, they're taking their money out of the banking system because they don't trust their own system. And if if they do not trust their own system, isn't that another signal that Greece is simply failing?
It absolutely is, but the thing is that the hot money has left. And when you're setting up a trade, getting in front of the hot money is your friend.
Hold on. But isn't the hot money hedge fund money? So to put on a successful trade as a hedge fund manager, you have to have a variant opinion. They are the hot money. Exactly. They are the ones crowding the trades.
Exactly right. And that's why you don't want to be necessarily in the Greek trade. In the Italian trade, you've seen Italian deposits go up by 17%. If they get a whiff of a problem in the Italian banking system, there's going to be a run of tremendous magnitude on the Italian banking system.
But that doesn't seem to be the case now. Tutto bene.
Tutto bene, perfetto. And here you've got something which maybe has got a 10% chance of occurring, but with a massive payoff. Right now, spreads are around 124. They've gone out to 550 on the last ones. The Greek CDS is 1/10 of what it was before. The Italian CDS...
1/10 as in where it trades, as or in the amount of notional outstanding?
As where it trades. It's literally trading for 1/10 of where it was at its peak. So does it seem
like investors aren't paying attention to what's really happening in Greece? Because back in 2012, Greek CDS blew out.
Exactly. And I think, you know, look, the balance of probability is that they will kick the can down the road. But what you want to look at is, yes, you've got a 90% chance of that not happening, and it might cost you $1. But if you can put on a trade that if it does happen and something goes wrong and you see, you know, the Greek speaking in that language and Merkel says, you know what, you're 8 million people, go pound sand. I'm not going to set a bad example for the Spanish and the Italians, and they do let them go, you're going to have a huge payout ratio. And that's, I think, what the hedge fund managers are looking for. Asymmetric payoff, and that's there in the Italian spreads.
What's the hedge fund vibe right now? What do you think January looked like? We know Ray Dalio had a good month, but a lot of hedge funds got hit the wrong way on the Swiss franc move.
You know, not that many would have had that carry on it. I don't think that they saw it going quite as far as it is. In general, with what you're seeing the hedge funds loving, Brazil, you know, with the changes there, with the spread widening out and a tremendous positive carry, you do see a fair amount of investors long Brazil. You also see some people still playing the Fed tightening. Above all else, it's a long dollar play. Every single one of them comes down. It's a function of, do you want to be long dollars versus oil-producing currencies, long, you know, short Canada, and energy currencies. You're also starting to see people looking at fixed currencies. If there is a hiccup, the pressure is the people who have set currencies. This goes way back to the sterling Deutschmark trade of old. But the currencies that have been locked in, particularly some of the currencies in the Gulf, are going to come under pressure. What people are trying to find is a way to get short the Venezuelan bolivar. That is the great white whale of hedge fund trades. If you can find a way to do it, people love that trade.